Hi there, Brian here. Welcome back to the Cash Flow Desk. Today we're diving into GAAP, Generally Accepted Accounting Principles. If you've ever looked at financial statements and wondered why they are structured the way they are, or why investors and lenders care so much about GAAP compliance, this video is going to clear that up. Here's what we'll cover: what GAAP actually is, the core principles that drive it, why it matters for your business, and we'll tackle a few common misconceptions that trip people up. So let's start with the basics. What exactly is GAAP? GAAP stands for Generally Accepted Accounting Principles, and you can think of it as the rule book for financial reporting in the United States. The whole point is standardization and consistency. Here's why that matters. If two companies both report they made $1 million in profit, GAAP ensures that number means the same thing for both businesses. Without these standards, one company might count a customer deposit as immediate revenue, while another treats it as a liability until the service is delivered. Suddenly, those profit numbers aren't comparable at all. GAAP creates a common language for financial reporting, so when you're looking at financial statements, you know exactly what you're seeing. Now, GAAP might seem like a massive, complicated framework, and it can be, but it's built on some pretty straightforward principles that shape how accounting works. Let's walk through the key ones. Consistency means you stick to the same accounting methods over time, so your results can be compared from quarter to quarter, year to year. You can't just switch methods when it's convenient. Relevance requires that the information you're reporting actually helps someone make informed decisions about your business. If it's not useful, it shouldn't be there. Reliability means your numbers need to be backed by solid evidence, not just hopeful estimates or creative interpretations. Comparability ensures your financial reports are structured so outsiders can line you up against competitors or industry benchmarks. And here's a big one: the accrual basis of accounting. This means you record revenue when it's earned and expenses when they're incurred, not just when cash changes hands. If you've ever wondered why your books don't match your bank account balance, accrual accounting is usually the reason. A consulting firm might complete a project in December but not get paid until January. Under GAAP, that revenue gets recorded in December when it was earned. So why should you care about GAAP? Let me give you 3 solid reasons. The first is credibility with investors and lenders. When you're raising capital or applying for a business loan, these folks want GAAP-compliant financial statements because they trust the numbers. Non-GAAP financials might look cleaner or more favorable, but they raise red flags about reliability. Second, it's often required for compliance. Banks frequently set loan covenants based on GAAP metrics, things like debt-to-equity ratios or minimum EBITDA levels. If your books aren't GAAP compliant, you could technically breach a covenant even when your cash flow looks healthy. Third, GAAP actually helps you run your business better. It gives you a consistent framework for measuring profitability and performance over time. Without it, you're essentially moving the goalposts every quarter, which makes it nearly impossible to spot trends or make informed decisions. Let's make this concrete with a couple of examples. Take a SaaS company that sells annual software licenses. A customer pays $120,000 upfront for a year of service. Under GAAP, that revenue gets spread evenly over 12 months, $10,000 per month, because that's when the service is actually delivered. This prevents the income statement from showing a massive spike in January, followed by 11 months of nothing. Or consider an e-commerce business that purchases $200,000 worth of inventory. Under GAAP, that purchase doesn't immediately hit the income statement as an expense. Instead, it sits on the balance sheet as inventory and only becomes cost of goods sold when those items are actually sold to customers. These rules keep your financial statements tied to actual business performance, not just the timing of cash movements. Before we wrap up, let's clear up some misconceptions that come up all the time. One is that GAAP is only for big public companies. That's not true. Even small businesses can benefit from GAAP reporting, especially if they're planning to scale, raise money, or prepare for an eventual sale. Another misconception is that GAAP is universal. It's not. GAAP is specific to the United States. Most other countries follow IFRS, International Financial Reporting Standards, which has some similarities but also key differences. And finally, Some people think GAAP just slows everything down and creates unnecessary complexity. In reality, it often makes processes like audits, due diligence, and investor reporting much faster because everyone already knows the format and expectations. Here's the bottom line on GAAP. It's not just accounting jargon or bureaucratic red tape. GAAP is the framework that makes financial statements clear, consistent, and trustworthy. Whether you're running a SaaS business, an e-commerce company, or a professional services firm, GAAP helps ensure your financial reporting reflects the real performance of your business. If you found this helpful, hit that like button and subscribe for more practical finance insights. Drop a comment and let me know what finance topic you'd like us to tackle next. Thanks for watching. See you in the next one.